The U.S. China trade war, initiated in 2018, has significantly impacted global economies, causing disruptions across multiple industries and altering trade relationships worldwide. Driven by disputes over intellectual property, trade imbalances, and market practices, this trade conflict led to the imposition of tariffs on hundreds of billions of dollars worth of goods, affecting global supply chains and creating economic ripple effects that continue to unfold. Overview of the trade war. The trade war formally began when the Trump administration imposed tariffs on Chinese steel and aluminum imports, accusing China of unfair trade practices and intellectual property theft. China retaliated with tariffs on U.S. products, leading to a tit-for-tat escalation that saw tariffs applied to a wide range of goods from both sides. By 2019, nearly all trade between the U.S. and China was impacted by tariffs, affecting sectors from agriculture and technology to consumer goods. Global supply chain disruptions. The tariffs disrupted the well-established global supply chains that have relied heavily on China as a manufacturing hub for decades. Many multinational companies faced higher production costs due to tariffs, prompting some to shift production from China to other countries such as Vietnam, Thailand, and Mexico. This shift disrupted established supply chains, led to increased logistical costs, and created uncertainties about the future of global manufacturing hubs. Impact on consumer prices. As companies faced higher production costs due to tariffs, many passed these costs on to consumers. Prices for numerous goods increased, particularly electronics, clothing, and household goods. For example, tariffs on consumer electronics led to price hikes in the U.S. market, affecting products like smartphones and computers. The U.S. consumer, reliant on affordable Chinese-made goods, faced higher prices, contributing to inflationary pressures. Agricultural sector losses. The agricultural sector, particularly U.S. soybean farmers, was hit hard by retaliatory Chinese tariffs. China, one of the largest buyers of American soybeans, imposed tariffs on the product, leading to a significant drop in U.S. soybean exports to China. This left American farmers with excess stock, causing a drop in soybean prices and resulting in billions in lost revenue. In response, the U.S. government provided subsidies to farmers to offset these losses, yet many farmers continue to feel the economic sting from the reduced market access. Tech industry and intellectual property concerns. One of the core issues of the trade war was U.S. concerns over Chinese intellectual property practices, including forced technology transfers and alleged IP theft. The U.S. imposed export controls on Chinese tech firms, limiting their access to critical technologies such as semiconductors. In response, China ramped up its efforts to develop its own tech capabilities, aiming to become less dependent on U.S. technology. This has spurred a tech race between the U.S. and China, with global companies caught in the middle, facing disruptions and increased costs. Global economic growth slowdown. The trade war contributed to a slowdown in global economic growth, as the uncertainty surrounding trade policies dampened business investment and consumer confidence. The International Monetary Fund, IMF, revised down its global growth forecasts multiple times during the trade conflict, citing the negative impact of trade tensions on international investment and trade. Emerging markets, many of which are reliant on stable trade flows, were particularly vulnerable to the economic uncertainty generated by the trade war. Increased costs for multinational corporations. Multinational corporations with complex global supply chains were significantly impacted by the tariffs, facing higher costs and logistical challenges. For instance, electronics companies reliant on Chinese manufactured components had to deal with increased costs, which impacted profitability and forced some to relocate production. These shifts, while sometimes necessary to avoid tariffs, were costly and required considerable time and resources, with some companies passing the added costs on to consumers. Investment slowdowns and market volatility. The trade war introduced a high level of uncertainty into global markets, resulting in fluctuations in stock markets and investment slowdowns. Investors, unsure of future trade relations between the world's two largest economies, often pulled back from markets, causing volatility. This affected not only the US and China, but also other economies linked to their trade networks, creating a ripple effect that dampened global investment. The Phase 1 Agreement and partial de-escalation. In January 2020, the US and China signed the Phase 1 trade deal, which aimed to ease some of the tensions by addressing specific issues, including increased Chinese purchases of US goods and services. While the deal brought some relief, it left many core issues unresolved, and tariffs on hundreds of billions of dollars in goods remained in place. The agreement provided temporary stability, but did not fully resolve the deeper structural issues underlying the trade war. Ongoing technological decoupling. Beyond tariffs, the trade war intensified a trend toward technological decoupling between the US and China. As both countries moved to protect their technological ecosystems, concerns over data security and supply chain dependencies grew. This decoupling has led to increased costs for tech companies that operate in both markets and has the potential to split global technological standards, complicating operations for multinational corporations that must navigate differing regulatory environments. Long-term implications for globalization. The U.S.-China trade war has raised questions about the future of globalization, as businesses and governments reconsider the risks associated with highly interconnected global supply chains. The pandemic further emphasized these risks, reinforcing a trend toward diversification and reshoring of production. This shift could have long-term implications, potentially leading to a less integrated global economy where regional supply chains become more prominent. The trade war between the US and China has had widespread consequences, affecting industries, consumers, and economies worldwide. From disrupted supply chains and higher consumer prices to strained international relations, the trade war has highlighted the interconnected nature of the global economy and the significant impact that economic conflicts between major powers can have on global stability. As both countries navigate this complex relationship, the future of US-China trade relations remains uncertain, with the potential to shape the global economic landscape for years to come.